Okay, in this video, I want to talk about one of my trading mistakes, which I did on Friday. So I'm recording this video on 14th of September. I don't know when this will get published. This might get published after a long time. But I just want to highlight one of my mistakes. Today is Saturday. And Friday, I made a mistake. And the mistake was lack of concentration. As simple as that. Okay, sometimes we get complacent and we don't pay attention to what is happening in the market, and you end up making a mistake. The mistake was not about buying a stock. The mistake was about missing out on an important opportunity, which I already had on my radar, by the way. So this is Newgen stock. Let me show you the stock. Sorry, this is Newgen. This stock. Have a look at this base. The stock shot up 9.24%. I had already marked the base. I had already marked my buy point. And while I was having my breakfast, the stock just skyrocketed and I was not paying attention. I was peacefully having my breakfast in the morning. And when I came back, I saw that the stock had already shot up and I could not get a chance to enter the stock. Now the stock has reached new high ground. So first, let us try to understand why was I considering this stock. Number one, the 50-day moving average is above the 150-day and the 150-day is above the 200-day. So this is a very strong stage 2 uptrending stock. Now, reason number one. Reason number two, have a look at this base. Okay, there are more than 10 candles in the base. I want minimum 10 candles in the base, which is 2 weeks of consolidation. Here you have comfortably more than 10 candles in the base. Next, you look at the contractions in the base. So this is 0.1. That's 0.2. Here is 0.3. I'm just joining the extremes. 0.4, 0.5, 0.6, 0.7. So there are 7 points in the base. And as you go to the right side of the base, notice that the price is contracting. Okay, every contraction is smaller than the previous contraction. There are 3 contractions. Number 1, number 2, and number 3. So point number 5 becomes my buy point. So that is why the high of this green candle, becomes my buy point. So my goal was to buy the stock as it was crossing that yellow line. And I missed it. Okay, how did I miss it? Let me show you on the hourly chart. So let's go to the hourly chart. So see, this was the first candle of the day. So as you can see, the volume on that day on that candle was 32,000 shares traded. Average volume was 32,000 shares traded. So it's close to average. But if you noticed the previous 10, 20 volume bars, okay, the volume is considerably below average, which means 50% or more below average. And suddenly from below average, you go to average. So there is a pickup in volume. Not just pickup in volume, but the price is also closing above the yellow line. Okay. So this was the point. So this candle is the first candle of the day, which means 9:15 to 10:15. Okay. That was the time in the morning when I was having my breakfast. So I was not paying attention to the stock. Even at 10:15, okay, I had ample time to buy the stock. It doesn't matter at what time between 9:15 and 10:15 am I buying the stock. I could have waited 45 minutes till 10 o'clock. And after 10, I could have started making my purchases. Okay. There was enough time for me to buy this stock. But since I was watching television while I was having breakfast, then I had some tea. Then I came here. I opened my computer. I saw. By the time I came, the price has shot up 6.57%, and this price spike happened in a very short period of time. It did not take 1 hour to form this candle. Okay, the price spike was very large in a very short period of time. So by the time I reached my computer desk, the price had already shot up more than 5% from my yellow line. So anything more than 5% above yellow line is an extended stock. I personally prefer that I would buy the stock within 1% of the distance from the yellow line. But in this case, it had gone way beyond my tolerance level. So I clearly missed this stock. Going back to the fundamentals. So this is called a classic case of lack of concentration. There is perfect price contraction, there is volume contraction. See, majority of the volume bars are below the blue line. So there is price contraction, there is volume contraction, a breakout is expected, which is what exactly happens. This is a strong uptrending stage 2 stock. Looking at the fundamentals, let's go there so that we get perspective. Of course, there were some problems with the stock. No stock is perfect or no stock is ideal. But let me explain. I will have to log in. Thankfully, my computer speed is now better so that I don't have to wait too much. This is Newgen software. Let's open up this. Okay. So this is the data. So I click on consolidated. I want to see consolidated data. Okay. See, there are dotted lines here. If I click here, that's 5C. Now this is one problem. This is a late stage base. So there is base 1, base 2, base 3, base 4, base 5. By the time a stock goes from base 1 and 2 to base 4 and 5, it has already gone up it has already given triple digit returns. Okay. So one problem with the stock is that it is late stage. I am buying the stock late stage if I were to buy the stock. But that's still okay. MarketSmith has marked the base. I have personally marked the base buy point on my daily time frame chart based on my own analysis of the base. Okay. Look at earnings, 33%, 57%, fabulous. Look at these earning, look at the sales growth out of the past 16, 20 quarters. Okay, there is only one quarter with no sales growth, but the sales has been continuously rising. Impressive sales and earnings growth. Then we come to the ratings. EPS rating 94, fantastic. Master score 81, super fantastic. Price strength is 84, very, very good. Okay. Accumulation distribution rating is A, which is very fantastic. Group rank is a problem. Group rank should be less than 40. So this is a stock which is not among the top 20 percentile of the industry groups or best performing industry group. There are a lot of other industry groups who are doing better than this particular industry. But this is a unique stock in a sense that it is an outperforming stock in an underperforming industry because maybe it is in its own earnings cycle. See, the funds are accumulating the stock. So if out of 5 parameters, if four are in my favor, so I should give the stock a chance. Okay, so I decided that I would go with 2.5% position because there is no industry group strength and the base is already where I'm buying it late stage in its stage 2 growth. Since I'm buying late stage and since I'm buying a weak industry, I decided that even if I want to get into the stock, I would not put more than 2.5% of my portfolio in the stock because there is some risk involved. But even that 2.5% is something that I could not put because I was not concentrating. I was not in front of my screen when that breakout happened. Of course, I had set my alert. My mobile phone was with me when I was having my breakfast. I thought, okay, I got the alert. Let the stock spend some time. On a 1 hour chart, I will try to buy the stock. I could have bought the stock exactly at 10:15. When it hit 10:15, I could have put my order. I could have pulled the trigger. Immediately after I had pulled the trigger, the stock would have gone up 7% in less than 1 hour. I would have made 7% in less than 1 hour. But I did not do that. I was not concentrating. I was relaxed. I was complacent. Okay. This is the problem if we do not concentrate. We have an opportunity. We have looked at all the factors. Even return on equity is in our favor. It is more than 17%. Operational cash flow is positive. PE ratio is at the higher end of the PE range. So it is not a low PE stock. Earning stability is small. Small earning stability means low number means high stability. Okay. And EPS growth rate, this represents 3 to 5 year compounded annual growth rate. So it's a very good stock. Okay. There is no problem. The only problem is it is late stage and it is in an underperforming industry group. That is fine. We can give the benefit of doubt to the stock. We could play this stock for a 20% move, sell half of the shares, move the stop loss to break even, and then maybe ride till it creates base 6, base 7 to capture some additional gains and wait till the stock breaks the 50-day simple moving average. That could have been done in this stock. Okay. Look at the contraction in volume during this period, during this basing period. Okay. If we look at this, so from here to here, during this basing period, majority of the volume bars are below the 10, 50-day simple moving average volume line. Okay. And whichever bars are up, majority of them are blue color bars, not red color bars, which means whenever the stock is going up, it is going up on high volume. Whenever the stock is going down, it is going down on low volume. Okay. That's a classic sign of accumulation in the stock. So the institutions are accumulating the stock. So everything was here. In spite of that, I did not pull the trigger. That's the mistake I wanted to point out. Okay. So next time I will be more vigilant. I will focus more. Maybe I will delay my breakfast by say 10-15 minutes, or maybe I will have my breakfast before even the market opens. Okay. Because what happens is our cook, she comes around 9, just before 9. And by the time 9:15 hits, the breakfast is ready and it is fresh and it is hot. So that's the time to have my breakfast. But unfortunately, the market also opens at exactly 9:15. So I either bring the breakfast at my office desk and have my breakfast while I am watching the stock, or I might have to have that breakfast earlier than before. So I need to talk to my cook basically. So these are challenges that traders don't discuss. Okay. These are things which are important in the life of a professional trader. Okay. We are very good at analyzing and spotting opportunities, but the problem is with trade execution. There are 3 steps in a proper uh, trading process. Number 1, stock selection. Number 2, trade execution. Number 3, trade management. Stock selection, trade execution, trade management. If these 3 things happen properly, simultaneously on every opportunity, that is where we increase our odds of success. Now, since I have already missed this stock, assume that this stock doubles in the next 3-4 years. That's a missed. That's something that doesn't get accounted for in my trading performance. Okay, that's a bigger loss than the small stop losses which I book, on which I make videos, because stop losses are 2%, 3%, maximum 4 to 5%. Okay, I never allow the stop loss to hit my 8% actual stop loss, which I keep with my broker. So losses are always going to be in the range of 4 to 5% on an average, but the gains, could be 100%. The stock could double in the next 1 year. So that's a 100% opportunity loss. Compare that to 4-5% average loss per trade. I mean, it is like taking a stop loss. Okay, this is a huge missed opportunity in the stock, and I have made a promise to myself that I will not repeat that mistake again. And you see how steadily the relative strength line is rising. Okay, if we draw a trend line here, the relative strength line is properly rising, and now you have a blue dot. Blue dot means a 52-week high on a relative strength line. Relative strength line compares the performance of the stock with the general market index, which in India's case is the Nifty 50. Okay, so what's the moral of the story? Moral of the story is concentrate. Concentrate. You are working very hard to find these stocks, and when you find, don't take it lightly. You might miss out on the opportunity, and if you miss, the stock could double in the next 1 year. Okay, don't do that. So I hope this video was helpful to you. Please support this YouTube channel. Your support is very valuable to me. When you like, comment, and share this video, it reaches similar or like-minded people like you who also want to become professional, profitable, consistently profitable stock traders in the market. Thank you so much.